Hello there, and welcome to the Smart Money Dumb Show. And I'm your host, as usual, Keith Richards. I'm President and Chief Portfolio Manager of Value Trend Wealth Management. And today we're going to talk a little bit about change because the market is always filled with change, rotation, things change, trends change, groups of stocks that were in control may remain in control for a long period of time, and then everything changes. Markets go from bullish to bearish. There's all kinds of change that we can anticipate on the market. In fact, I think someone said that the only thing that is permanent is change itself. I think that was the rock group Rush. That is my favorite rock group, and that was one of their songs. They said the only thing that stays in place is change. So today's talk is about a change that is occurring in the NASDAQ. And it's really a change that's occurring within the high growth stock era. If we go back, and I'm talking go way back to 2010 and on, there was a big revolution in technology names. The stocks really took off. When President Trump was elected, they really arced because he was very accommodative for business and kept the pressure on the Fed to keep monetary interest rates and whatnot low, and that really helps growth stocks. Now things have changed. We have a high inflation environment now because of COVID and supply chain and other things like borrowing like crazy by governments to fight COVID, plus sometimes just borrowing to meet certain political agendas. And I won't go too deep into that. But whatever the case, we're seeing a change in the environment that has been very beneficial for growth stocks. And before I get started, I thought I would show you a poster that I keep, a picture in my office. This is my home office. So sometimes you'll see these videos recorded in my office at work, and sometimes I do these videos at home. So this is my home office. And in my home office, I'm turning the camera, you will see this picture. Now, it may be a little hard to see it, but what you're seeing here is this man is helping this man light up a cigarette. This is the Tour de France in 1930s. I don't know the exact year, but it was in the 30s, before World War II. And it was considered a benefit to smoke cigarettes before you hit the mountains. Now, back then, it's a couple of interesting things you won't see unless you look really close. But back then, there was a couple things that these cyclists dealt with. One thing is they didn't have gears, so they had a one by chain ring, and the way you change gears to go into the mountains is you flip your wheel around, because on one side there would be a bigger cog than the other. So the bigger cog was, okay, we're going into the mountains, we're going to climb, we're going to switch the wheel around so the big cog is on the chain, and if it's flat grounds, you use the smaller cog. The other thing in this picture is that the reason these professional bicycle racers of their era were smoking a cigarette before a mountain stage is because the hardest work done in any bike race is on the hills. Anybody that's even just bicycled casually, no, it's hard to climb hills. You pant, you breathe hard. Well, they thought that smoking cigarettes opened up the lungs. Oh, that fresh tobacco air will just help us breathe better. That was a belief that they believed that tobacco would expand your air capacity within your lungs. Well, how things have changed, because we now know, I'm bringing away from the picture now, of course we know that the worst thing you could do as an aerobic athlete is to smoke cigarettes. I mean, you literally couldn't pick a habit to reduce your ability to ride on hills on a bicycle in any sport that requires you to use your aerobic capacity. Tobacco coats the lungs with nicotine and reduces your overall capacity. So we know that now, but back then they thought they were opening up their lungs and make them even stronger on the hills. Well, that's a sign of change. So because we've evolved to believe differently. And it's the same with the change that I'm seeing on the markets now. And that is that we're evolving from a market that was focused on the stay inside trade and even before that, the growth trade, where these very high quality companies, like not bad companies, such as Amazon and Google and Tesla, and you know who they are, Facebook, etc., Apple, Microsoft. They took the reins and led the market for good reason. They were good stocks, they're good companies, they're growing their earnings, they have fabulous products, but they rely to grow on low interest rates because these guys borrow to invest in new technology. Look what Google's been doing with the self-driving car, Tesla. All these companies are great, great companies, but they borrow. And of course, as investors piled into the stocks, their prices were accelerating faster than their actual earnings growth, which was strong, but the prices were accelerating at a faster rate than their growth. And that's called multiple expansion, price to earnings ratio expansion. And at the same time, the recent announcements of the Fed raising interest rates to combat inflation in 2022 and beyond has suddenly made investors realize that, hey, I've got a basket full of overvalued, possibly overpriced stocks, and I'm going into an environment where they're already somewhat overpriced earnings are going to maybe even be under some pressure because the interest costs on their financing is going to go up. So we've seen a rotation. So I want to bring you to the charts right now. I want to show you exactly what I'm talking about. Now, before the NASDAQ started pulling back recently, at the beginning of December and even in November, on this video, I started talking about how there would be a bit of pressure on the NASDAQ. So this is my write-up on December 14th. And in November, I did a video on the same subject, which is the NASDAQ was painting a worrisome picture. So if you keep up with my blogs and my videos, you will have heard this before from me. So I'm going now directly to the NASDAQ chart. And here's the reason why I explained on both my video back in November and my blog in December, why this sell-off on the NASDAQ is not exactly a surprise to me. And here's why. This is what I talked about, is that we saw some divergence on these momentum indicators. We saw in particular the MACD, which is a long-term indicator, and divergences on the MACD, which means that the MACD's momentum was declining, even though at the time the NASDAQ was going up. MACD was trending down, and you probably saw me talk about this on this video back in November and in the blogs. So it doesn't surprise me that not only did we have a declining or diverging NASDAQ MACD, but we also had a high level, an overbought level on some of the slower moving indicators. We're also starting to see, going back a while ago, this is a relative strength line. This is how the NASDAQ is doing against the S&P 500. Now, remember, some of the stocks that make up the S&P 500 are the biggies in the NASDAQ as well. But you can see that there was some divergence there, that the NASDAQ on a general basis was beginning to underperform the broader S&P 500, let alone the Dow Jones Industrial Average, which is very underweight the technology stocks. So this was another sign. And finally, I want to just point out that this red line is the 200-day moving average. And what you are seeing is the first in a series of high, low, lower, low, and a possible correction through the 200-day moving average. Now, anybody that follows my work knows that I like to wait a few days at least before proclaiming the end of an uptrend, because the last significant low was back here in October, and that has not been cracked. But the more recent, less significant low has been cracked, and the 200-day is on the verge of being cracked. It is, the market has broken down through the 200-day, but it's very early in that. You can see it's really more of a tail on this candle. It's very small. So this is a weekly chart. And in fact, if I were to change this look to a daily chart, here we go. You can see there's the lows. It was taken out, but it is kind of moving back into that area. So that zone. We don't want to draw conclusions that this is a new bear market for the NASDAQ, but I will draw conclusions saying, look, we definitely have lower highs. We probably have lower lows, and ignore the moving averages on this. This is transcribing the same periods on the daily chart, which are insignificant. I tend to use the 200-day, and that's not what we're looking at here. So if we're looking at the look of the bars though on this daily chart, you can see there is some probable trouble, and we shall see in the next little while. Now on the near term, the stochastics is a little bit oversold, it's bouncing up, and so is the RSI. So it may have some reprieve, but you're seeing that underperformance against the S&P. You're still seeing that massive divergence even on the daily chart by MACD. So I am a little concerned about the NASDAQ, and I think it's like the Tour de France smokers. That was yesterday's story. That was the way to open your lungs back in the 30s. That was the way to have high performance cycling. And the NASDAQ has been the way to have a high performance portfolio for the past few years. I am wondering if that era, for the time being, at least for the next couple of years, may have ended. And if you read my blog regularly, you'll know that I have been pushing you to at least consider holding some of your assets in materials and inflation adjusted securities like commodities such as oil and metals, things like that. I've also talked about value stocks. And the other thing we can look at is, as interest rates are rising, look at the financial sectors that benefit from rising interest rates and inflation. A lower dollar is probably going to be coming your way, a lower US dollar, and that means that eventually even gold and silver will start to look good, although they haven't yet. So these are things we need to keep in our mind, and we need to start to divert our attention away from and divert our portfolio out of the technology growth stocks. Doesn't mean you can sell them all. You maybe keep a small amount, but pick the best of the best and pick the least leveraged and the lower PE ratio versions of these great growth stocks, but focus and concentrate on value, inflation protection, and interest rate sensitive to the positive stocks in your portfolio. So I hope that helps. I think this video is one of the ones that I want to have you ingrain the message into your mind, because this is a very improper, or I should say proper message for the current times, and I think for the year 2022. We'll see you next week.